Welcome to this explainer. You can really think of a business partnership kind of like a high-stakes business marriage. Just like a real marriage, when two or more people join forces, trust is absolutely essential. But trust alone, well, that isn't going to keep the lights on. You need rules. You need a rock-solid understanding of who owns what, who does what, and exactly what happens when the money starts rolling in, or, heaven forbid, flowing out. So if you've ever wondered how accountants keep friends from becoming sworn enemies over money, you are definitely in the right place. Today, we're unpacking the basic concepts of partnership accounting. Think of this explainer as your essential survival guide for how these business marriages are officially tracked, managed, and kept perfectly financially honest.
So here's our roadmap for this explainer. 1. What is a partnership? 2. The partnership rulebook. 3. Tracking partner capital. And 4. Slicing the profit pie. Let's dive in.
Section 1. What is a partnership? The basics of the business marriage.
To get this absolutely right, we've got to look at the official definition. According to Section 4 of the Indian Partnership Act of 1932, a partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Now, what's really fascinating about this definition is that very last phrase, acting for all. That right there is the entire cornerstone of a partnership. It's a concept called mutual agency. Basically, it means every single partner is both a principal and an agent. You can bind your partners to a contract by your actions, and, more importantly, you are bound by the actions they take on behalf of the firm. It goes both ways.
Building on that definition, there are a few essential features you have to call it a partnership. You need two or more persons coming together, obviously. You need an agreement, whether oral or written, to share profits and losses. There has to be an actual legal business being conducted. Just co-owning a piece of land together doesn't magically make you partners. We already touched on mutual agency, which is huge, but I really want to draw your attention to that final point, unlimited liability. Guys, this is the big flashing warning label on the partnership box. Each partner is jointly and severally liable for the acts of the firm. This means if the business owes a debt it simply can't pay, your personal assets, we're talking your personal bank account, your home, can legally be used to pay off those firm debts. The stakes are incredibly high here.
Oh, and before we move on from the absolute basics, let me drop a pretty surprising fact from the source material. So you only need 2 people to start a partnership, right? But how big can it actually get? 50. That's it. The central government has prescribed that a partnership firm can have a maximum of exactly 50 partners. So no, you can't go out and form a 1,000-person partnership firm. There are strict legal ceilings in place. All right, moving right along to Section 2, the Partnership Rulebook, setting the rules before the fight.
So how do you avoid nasty disputes down the road? Well, the single best way is to draft a written partnership deed. This is your foundational document. Now, the law doesn't technically require your agreement to be in writing. An oral agreement is legally valid, but relying on an oral agreement when money is involved, that is just asking for trouble. The deed contains all the absolutely crucial terms: the objective of the business, how much capital each person is bringing to the table, the ratio in which profits and losses will be shared, and all the nitty-gritty rules regarding interest, salaries, and how you'll settle disputes. It is literally the constitution of your specific business marriage. But what happens if partners just don't create a deed, or if their deed happens to be silent on a specific issue? This contrast between planning ahead and letting the Indian Partnership Act of 1932 step in as the referee is brilliant. If you have a deed, everything is as agreed. You make the rules. But look at the default rules if you don't. Profit sharing? It becomes absolutely equal, period, regardless of who put in more money or did way more work. Interest on capital? Nil. No partner gets a dime of interest on the money they invested. Interest on drawings, the money a partner takes out for personal use, also nil. The firm can't charge interest on those withdrawals. The default rules are incredibly rigid, which is exactly why taking the time to draft a deed is so critical. So the crucial takeaway here is knowing those default rules. And there is one highly specific default rule you absolutely must remember: 6%. If a partner gives an advance or a loan to the firm, meaning something totally beyond their initial capital contribution, and there is no partnership deed specifying an interest rate, well, they are legally entitled to exactly 6% interest per annum on that loan. The law basically ensures that partners acting as lenders to their own firm get compensated, even without a written contract.
Let's get into the mechanics in Section 3, tracking partner capital. Basically, who owns what?
Unlike a sole proprietorship where all the business equity just belongs to one single person,
A partnership needs specific, completely separate accounts for each and every partner. Partner capital accounts are used to track every single financial interaction a partner has with the firm. This includes the initial money they brought in as capital, their share of the profits earned, any interest accrued, any salary or commission they might be owed, and of course, the withdrawals, often called drawings, they've made for personal use. Think of it as a running, detailed tally of their exact slice of the business pie.
Now, accountants generally use two main methods to maintain these records. First up is the fixed capital method. Here, you actually maintain two separate accounts per partner. The main capital account remains fixed. It only changes if they permanently add or withdraw core capital. All the day-to-day adjustments like profits, drawings, and interest, those go into a totally separate current account. Then we have the fluctuating capital method. This is much simpler, just one single account per partner. Every single transaction from the initial investment to daily profit shares goes into this one pot, meaning the balance, well, fluctuates constantly. And here is a key takeaway. Fluctuating is the default method. If the partnership agreement doesn't specify which one to use, the fluctuating capital method is standard practice.
Which brings us to everyone's favorite part. Section 4, slicing the profit pie. Time to get paid.
To do this fairly and accurately, partnership accounting introduces a very special ledger called the Profit and Loss Appropriation Account. This is really just an extension of your regular P&L account. Once a business figures out its overall net profit, that money doesn't just immediately get dumped straight into the partner's individual bank accounts. No way. It goes into this appropriation account first. This is basically the specific staging area where all those adjustments, like partner salaries, commissions, and interest on capital or drawings, are carefully calculated and handled before the final remaining profit is actually distributed according to their agreed ratio.
Let's follow the money flow here in 3 logical steps. Step 1. You ascertain the overall net profit using the standard P&L account. Think of this as the business's total earnings for the year. Step 2. That money moves over to the P&L appropriation account we just talked about, where we make the specific partner adjustments. Deducting the salary promised to partner A, adding the interest owed by partner B. Finally, step 3. Whatever profit is left over is the final share, and that is then transferred directly into the individual partner capital accounts. It's a beautifully clean, auditable trail from the business's total earnings right into the individual partner's pockets.
So I want to leave you with a final, somewhat provocative question. If your business partner made a genuinely terrible deal today, are your personal savings protected? As we learned earlier, because of mutual agency and unlimited liability, the answer is very likely no. Your personal assets are absolutely on the line. And that, my friends, is exactly why mastering these basic accounting concepts, having a rock-solid partnership deed, and maintaining perfect capital and appropriation accounts isn't just about doing good bookkeeping. It's literally the only way to survive and thrive given the incredibly high stakes of a business partnership. Thanks so much for joining me for this explainer, and keep learning.